I'm from CryptoMentors. We are here to help you to become a better trader and to become also a profitable trader. Our first objective is to teach you the basics of trading, but if you already have experience in technical analysis or in fundamental analysis, in reading charts, in stocks, or in cryptocurrencies, well, you will find here some helpful information, of course. In every video, I will try to mix some basic knowledge for a new user, but also some medium and advanced content, so everybody can enjoy watching this video. This is the first video of our educational series, and I hope you will enjoy. Okay, so first of all, let's start from really the basics. What we are looking at? This is a chart, and every element of this chart is known as candle. Okay, these green and red boxes, together with the shadows you see on upside and downside of each candle, is a candle. So let's make it more clear. Let's use a rectangle. What you see here in this rectangle is called candle. A candle can be, in this case, a green candle, where the price is from the beginning of the candle started growing till its close, or it can be a red candle, just like the next one, where price retraced, started from a specific point, it was high, and closed on a lower price. So let's be more specific. What you can call here, how can we call this? This is a shadow and body. Okay, this is the two main elements. This is the body, okay, and here we have two shadows. This is the first one, and this is the second one. So a green candle is when price opened at a specific value and closed at an upper value. So in this case, here you can see the price, the open price is 11,764, and the closing price is 12,905. The shadows show us the low point, the low value, and the high value of the candle. So this is called high, it's almost 14,000, and this is the low, which is 11,616. Okay, we are just describing the real basic element of the candle. Okay, so just let's write it down. This point is the high. While this is the low. Okay, let's use a different color for the low. This is the low, and this is the high. If you want to make a screen, of course you can do it. Just to be clearer, as clear as possible. Okay. So, very simple. Each candle has always these 4 elements. The open price, the close price, let's use the red. So in this case, this is the close price of the green candle, while this is the open price of our candle. If we check a red candle instead, the open close price position are vice versa position. This is the open price of the red candle, this is the close price. Okay, so the open is upper and the close is down. Okay, this is because in this candle the price retraced. So what did I wrote here? Open. Okay. So let's remove all this stuff. Now, another important step is understand the trend. Of course, it's important to understand that if we are in a bull trend, so in a bullish trend, when prices will go up on average, despite being in a bearish trend where price tends to go down. In order to understand these topics, I suggest you to use the moving average. Moving average. This tool is very interesting. I will add 4 moving average just to show you something very cool. Okay, so let's start with the creating our tool set. Okay, I just make TradingView draw these 4 moving average, the 20, 50, 100 and 200. When we can believe we are in a bullish trend, let's check this example. Almost everybody should know about the bullish trend of Bitcoin during the 2016. So just 2 years ago. It was a pretty amazing this bull run. What can you see? What can you see? You can see that all this moving average, especially the 200, were always moving upwards, have a clear direction upwards. They never, almost never try to go on a downwards direction. So starting from the end of 2015, all these moving average were going higher and higher. Okay, so this is a clear bullish trend, while they started moving down. Almost whole, especially here in June on 2018. Also the slowest, the 200 moving average, started being bearish and started being again bullish here 1 year later, some months ago in June, and it is still growing. And basically currently it's, as we can say, it's supporting price action. It's working as a support for the Bitcoin price action. So I just introduced a new concept, the support. What's a support? A support is something that make in this case the price being stable over it. So for example, let's check the 2016 here. As you can see, you can see some shadows here, but the 200 moving average usually was never broken. You can see only the shadows are going to touch the 200 moving average. We don't see any candle with a close below this moving average. And for example, we can say that it's supporting price action upwards. Also here, for example, the 100 moving average here is supporting a price action. So there was a run, an upwards run, then it's a retracement, but price stopped its retracement on the 100 moving average, which acted as a support. On the contrary, if we check the bearish side, we can see here, for example, the 200 moving average working as a resistance. So what I mean when I say resistance, I mean that make price stay below it. So he acted as a resistance. Okay, and all of these are bearish signs. Okay, you must be aware of it. While on this case here, you can see the 100 being a support again, 100 be a support. Here the 50 moving average was a support. Okay, also here it was a support during the main the big crash of the Bitcoin bubble at the end of the 2016-17. Okay, here the 100 moving average was trying to act as a support, but finally it broke. Okay, it broke down badly. Okay, so you should have understood also the concept of support and resistance. you should have understand also this this concept. Okay, but when we talk about the moving average, you can see a lot of nice information called as golden cross and death cross. Golden and death crosses. What does they mean? What does they mean? Okay, let's just try to remove everything. Okay, we lost. Okay, no problem. In order to see death cross and golden cross, you have to take as active only 50 and 200 moving averages. So when the 50 goes cross upwards the 200 moving average, then this is called the golden cross. Instead, when it happens that the 50 goes below the 200, this is called as death cross. Why they are so important? Let's see the chart from this point of view. Okay. Okay, just to be sure to see it, let's do this way. Let's draw a vertical line here so we don't lose this point. Okay, so here there was the golden cross, which make price really fly. We can suppose check here. We had a price grew 67 times. Okay. After the bearish cross here, the price went down. Well, only 66%, not so much, but it was in very strong for who lived the bearish here, because we had a drop of 84%. Okay, but now we have also a golden cross. We have a golden cross here, a death cross here, but what does this mean? This means that Bitcoin is again a fact? No, I don't think so, because the nice thing of charts of trading is the history repeats itself. Okay, in 214 and 15 and 16 it was just very similar to current situation. Death cross, golden cross, a new death cross, then we have this period of some other death and golden cross, but then this rise starts. Okay, so let's keep in mind this image and let's check this. This is just like the first part. Now we are in the second part. So what I suppose here, that the 15 will do something like this, with the 200 being a little bit like just like this, and try to do it in black, and to do this in orange. Okay, so maybe it will happen again something like this. Okay, a new golden cross, maybe in this point or something like this. But we will see. Okay, so we also explain another big important concept. What can I explain you also? Okay, let's activate again all of the moving averages. About these crosses, for example, let's check the past history. Let's do this way. Let's take only the 20 and the 50 moving averages as active. As you can see, these crosses are meaningful. Okay, as you can see, when we have a bullish cross, price goes up and goes down after a bearish cross. So what's a bullish cross? This is clearly a bullish cross. Why is defined as a bullish cross? Bullish cross, let's do it in green. This is a bullish cross because a lower moving average, the 20 in this case, is going over a lower moving average, the 50. Okay, in this case. So if a lower moving average goes over a higher moving average, then this is a bullish cross. On the contrary, of course, this is a bearish cross. Because the slow moving average is going down. Okay, and you can find a lot of this information. You could simply trade using these bullish and bearish crosses, for example. You can see a lot of useful crosses. Okay, a lot of useful crosses. This is very nice. As you can see, a lot of possible trading opportunities. And here you see 100% trade without leverage. Okay, but what can I suggest you? Let's introduce another important concept, the risk management. Well, this will not be a proper risk management lesson, of course. It must be explained very well in a specific video, but what I can explain you here very easily is that if you decide to enter in a position because you see a bullish cross, for example here, and you decide to have a 5% stop loss, so something like this, then be sure to have at least a reward ratio which is at least 3. Okay, it must be at least 3. You may ask why it must be at least 3. Well, the point is that on average, if it's not at least 3, you risk to lose your money. all your money, all your capital. And the most important thing in the trading world is not lose your capital, because if you lose your capital, you lose everything. Okay, so here what I would do, I would follow the trend moving upwards, my stop loss. For example, if I entered here, I would have moved it always a bit higher, so with a trailing stop. Okay, so that's all for this lesson. I hope you enjoyed a lot. I did. And let's see in the next one. You can write us, of course, in the chat. So have a nice day. Bye, guys.